Hello, I'm Gabriella Justine, welcoming you to Tech Newswire. Today's headlines: October jobs. Data may signal a soft landing. What it means for the USA economy. The U.S. economy is closely monitored for signs of a soft landing, a scenario where inflation moderates without the economy sliding into recession. The recent October jobs report suggests that this possibility is becoming more realistic, especially as job growth and labor market data continue to evolve. Let's explore what the data shows, how it impacts Federal Reserve policies, and what this could mean for the future of the U.S. economy. The key takeaways from October's jobs report. October's jobs data revealed continued resilience in the U.S. labor market. According to the Bureau of Labor Statistics, the U.S. added approximately 200,000 jobs, which, while lower than September's impressive figures, still exceeded the expectations of many economists. The unemployment rate held steady at 4.1%, reflecting an economy that, while slowing, remains far from stagnation. This slowdown in job creation can be viewed positively, as it indicates a gradual cooling off of the red-hot labor market from earlier in the year. The slower growth could help ease wage inflation pressures, a key concern for the Federal Reserve as it seeks to bring inflation under control without triggering mass layoffs or a severe recession. What is a soft landing? A soft landing refers to a situation where the Federal Reserve raises interest rates enough to curb inflation but avoids pushing the economy into a recession. It's the ideal scenario where inflation slows, economic growth cools to a sustainable pace, and unemployment remains low. In the context of the October jobs data, the term soft landing is being used because the report shows a labor market that is cooling just enough to ease inflationary pressures without causing a significant rise in unemployment. The role of the Federal Reserve. The Federal Reserve has been aggressively raising interest rates since early 2022 in response to the soaring inflation. But as inflation begins to moderate, the Fed is watching labor market data closely to determine its next steps. Historically, rapid job growth has been associated with higher inflation as employers compete for workers by raising wages, which can then lead to higher prices for goods and services. However, with job growth slowing in October and inflationary pressures easing, the Federal Reserve might be inclined to pause or slow its rate hikes. The CME Group's FedWatch tool has shown a shift in market expectations toward fewer and smaller rate hikes in the coming months, reflecting a growing belief that the economy might achieve a soft landing. The impact of slower wage growth. One of the critical indicators within the jobs report was the slowing pace of wage growth. Although wages continued to rise in October, they did so at a much slower pace than earlier in the year. Slower wage growth can reduce the risk of a wage price spiral, where higher wages lead to higher prices, which in turn push wages higher in a vicious cycle. For the Federal Reserve, this is a welcome sign. While workers may not be seeing rapid wage increases, the slower growth helps to bring inflation under control, making everyday goods and services more affordable over time. Additionally, slower wage growth can help ease pressure on small businesses and other employers struggling to keep up with the rapid pay increases seen in the post-pandemic recovery. Sectors leading the job growth. While job creation has slowed compared to the year's first half, some sectors continued to expand in October. Healthcare, leisure, and hospitality were among the industries showing the strongest job gains, reflecting ongoing demand for services as Americans continue to spend on travel, dining, and health-related services. Construction and manufacturing, two sectors that had seen significant growth earlier in the year, reported slower hiring rates as higher interest rates began to bite into demand. Conversely, sectors such as technology and finance saw more muted growth or even job cuts as companies adjusted to a more uncertain economic environment. The tech industry, in particular, has faced challenges related to rising costs and slower demand for new services, prompting some firms to reduce their workforce. Consumer spending and inflation. One of the significant drivers of inflation in recent months has been strong consumer demand, particularly for services. Despite higher interest rates, American consumers have continued to spend, supported by wage gains and pandemic-era savings. However, with wage growth slowing and inflation gradually easing, consumer spending is expected to decelerate in the coming months. Slower consumer spending could help further reduce inflationary pressures. making it easier for the Federal Reserve to achieve its 2% inflation target. If inflation continues to fall without a sharp rise in unemployment or a significant slowdown in consumer spending would be another indicator that the economy is headed for a soft landing. Looking ahead, what to expect from the Federal Reserve? The Federal Reserve's next policy decision will hinge heavily on upcoming economic data, particularly inflation and labor market reports. If inflation continues to moderate and job growth remains steady, the Fed may opt for a more cautious approach to further rate hikes. This would signal that the central bank believes it is on the right path to achieving a soft landing. However, risks remain. The economy is still vulnerable to external shocks, such as global supply chain disruptions, geopolitical tensions, or unexpected inflation surges. If inflation were to spike again, the Fed might have to resort to more aggressive rate hikes, which could push the economy into a recession. The global perspective. The U.S. economy doesn't operate in isolation, and global factors also play a role in determining whether the Fed can achieve a soft landing. In particular, Europe and China are both facing significant economic challenges, with Europe grappling with energy shortages and China dealing with a real estate crisis. These issues could spill over into the U.S. economy, making it more difficult for the Fed to balance inflation control with job growth. Additionally, international trade and supply chain disruptions continue to pose risks to the global economy. Any major disruptions could lead to higher prices for goods in the U.S., which would complicate the Fed's efforts to keep inflation under control while maintaining strong job growth. Just before we wrap up, we are made to believe that the October jobs data offers a glimmer of hope for the Federal Reserve's disruptions could lead to higher prices for goods in the U.S., which would complicate the Fed's efforts to keep inflation under control while maintaining strong job growth. Just before we wrap up, we are made to believe that the October jobs data offers a glimmer of hope for the Federal Reserve's goal of achieving a soft landing. While the labor market has slowed, it remains strong enough to avoid a significant rise in unemployment. Slower wage growth and moderating inflation are positive signs that the economy is adjusting to higher interest rates without collapsing into recession. That said, the journey toward a soft landing is far from guaranteed. The Federal Reserve will continue to monitor economic data closely and adjust its policies accordingly. For now, though, the October jobs report is a step in the right direction, suggesting that a soft landing remains within reach. This delicate balance between inflation control and economic growth will continue to dominate economic discussions in the coming months, with all eyes on the Federal Reserve as it navigates these uncharted waters. Here we are. Thanks for watching. See you in our next bulletin. Have a wonderful day.